A gentle reminder for everybody to put their phones on silent mode during the meeting. Okay, coming to the capital markets, as we all know, Nifty is the Sensex is running at around 66,000, Nifty at around 20,000. With India going towards the 5 trillion economy, the question is what next? Where are we headed to? And to answer the same, we have with us Mr. Mihir Vora, who will be explaining to us about all of this. For formally introducing our today's speaker, learned speaker, I would like to invite CM Mahesh Pagaria ji, who's also a past candidate.
A very good morning. Thank you, convener. As told, the Indian economy has to go 5 trillion. That target has been set, and stock market is witnessing that, how it is going to go do that. It has been all-time high, and so far all-time high. But this is not the end, this is the starting of the journey. To go 5 trillion, it has to above 1 lakh. Today is 66 and all that, but definitely it has to go up, and the index, the Sensex, has started doing his job. Not only that, stock exchange is always supported by the economic activities, the growth of the country, the manufacturing, service, another index, startups. Every item is supporting the Indian economy. For a week, the market has been down, was down, just because some FIIs were pulling back or reaping the profits. It's a temporary phenomena, according to me. India has to go ahead. And for that, to tell us all about this, we have today the learned, the best of CIO, the speaker, Mr. Mihir Vora, with us. Please welcome him. Mr. Mihir Vora, till recently, is a senior director and chief investment officer of Max Life Insurance, managing 1,30,000 crores of assets. 1,30,000 crores of assets he was managing. He was responsible for the investment strategy at all aspects of the company's fund management function, leading a team of 25 highly qualified professionals. A mechanical engineer, he is an alumni of IIM Lucknow and CFA from CFA Institute of USA. Mihir has 29 years of investing experience across assets classes including equity, fixed income, real estate, and alternate funds. He has a long, consistent track record and has delivered superior fund performances, built high-performing investment team in multiple organizations, including mutual funds, sovereign wealth funds, insurance across large cap, mid cap, sectoral, and thematic mandates. He has worked with Birla Sun Life Asset Management as a chief investment officer offshores, and before that, he was with Abu Dhabi Investment Authority. He has also worked with HSBC Global Asset Management and ABN AMRO Asset Management as head of equities. In the initial part of his career, Mihir worked with ICICI Prudential and SBI Fund Management as a fund manager. One of the most respected and visible CIO, Mihir is a regular speaker, panelist, and writer on TV and print media. He is also popular on social media like Twitter and LinkedIn. Mihir is very shortly going to announce his new initiative in the asset management space. We eagerly look forward to his next venture and our best wishes with him for the new venture for the same. Friends, with this, I request you all to please welcome with loud applause. Request our past conveners to please join me for welcoming him with towel bouquet and memento. Both of you. NFJ and yes.
Yes. Yeah.
Slide change. Open the arrow keys also and the slide change. Which are the same.
मेरी आधी स्पीच तो आई थिंक महेश जी ने ही कर दी 60,000 से 1 लाख तो आपने करवा ही दिया तो मुझे ज्यादा बोलने की जरूरत नहीं है फिर so good morning. It's always a pleasure to be at the CA Institute branches, and for some reason in this year this is my third presentation at the CA Institute. I've done one in Ahmedabad, two in Ahmedabad actually, one in Rajkot chapters for their functions. So I think it's always good to interact with the CAs because you guys are actually very well clued on to the corporate world and probably have a good ground view of what's happening in the companies that you are auditing or covering or consulting for. So it's always a pleasure. So thank you for inviting me. It's also a unique time in the history of the markets where we are at Nifty 20,000, close to 20,000, and there is a good amount of euphoria in the country with good reason, of course. But there's always, two sides of the coin. When things are too good, sometimes they become too good to be true. So we'll examine all the aspects. But whatever I say, it has to be against the backdrop of the firm belief that ultimately India as a country has delivered and will continue to deliver superior returns for long-term investors. So उसमें तो कोई doubt ही नहीं है कि as long as you stay invested and do the right quality control on your portfolios, India has given very good compounded returns, not only in rupee terms, but even in dollar terms over the longer term. How much time do we have? Okay. Okay. That's fine.
Either 10 minutes break and looking for the president.
Okay. No problem.
That's it. 11 तक में चलेगा.
हाँ, so मेरी स्पीड उस तरह से करूँगा. Yeah. So गुजराती में बोलते हैं ना कि શું લેવાનો? The first question I get is શું લેવાનો? So first of all તો India લેવાનો. And any pachi you choose what you want to buy within India. So that's the broad thesis that we will work with. But this is not just a sentimental analysis. It's based on facts. It's based on data, because there's always the narrative part, the sentiment part, and then there is the numbers part, which you guys are responsible for. And by the way, one more reason I like to interact with CS is always to drive home the message that you guys are one of the foundations of the financial markets. The reports that you audit, the reports that you authorize and put your signature on are the numbers that we use to do our financial analysis. So if those numbers are not right or not in the right spirit, then our fundamental analysis foundation is weak. So please, continue to produce high quality audited numbers and high quality audits of the companies, and because that's the fundamental, that's a starting point for us, right? We cannot trade on unpublished price sensitive information. So whatever you are publishing on a quarterly basis, on the annual report, with your qualifications, without qualifications, is our starting point for analysis. Then of course we look at the numbers, we look at the notes to accounts, we look at the qualifications, then we meet the management, understand the business. But ultimately, nothing is right if the numbers are wrong and if the qualifications and the notes are right. So please, my request to you is to continue to do the good work and continue to improve on the quality of reporting that the auditors and the CAs are doing. So request and thanks for that. So as I said, the analysis is based on facts and numbers, not on sentiment alone. So what now? The markets are at a high. So what now? The only answer is look long term. Because if you're a trader, it's a different matter. But if you're an investor, then you have to take a longer term view, not only when the markets are up, but also when the markets are down. Because sentiment is something that will prevent you from making the optimal returns. When the markets are down, the dominant emotion will be fear. When the markets are up, the dominant emotion will be greed. So you need to be completely neutral in your emotions as far as possible. It's not possible to be neutral. So just take a firm resolution that whatever happens, we will stay invested in the market and not try to time the market beyond a point. And of course, when we say that systematic investments is the right way to go, it makes a lot of sense because markets are trending, but there are corrections. So in a SIP, you are committing yourself for the long term and not putting a big chunk in one load. So you are neither trying to time the bottom, neither trying to time the top, but you're staying invested for a long period of time. And our savings and income streams are also on a monthly basis or a quarterly basis or a yearly basis. So the systematic investment plan kind of makes sense. So look long term, stay long term, because Bhav is Bhagwan. Ultimately, we all want to make money on the price of the stock, on the price of the market, which is the Nifty levels. But when we say Bhav Bhagwan, what are the drivers of that Bhav? What are the drivers of the market? What are the drivers of those prices? What is the foundation of the Bhav? Very simple. Economic growth leads to profit growth, leads to price growth. And it's amazing the kind of correlations that are there, the kind of, absolute numbers are there, which I will share with you. If you look at the last 30 years of data, 35 years of data, our GDP in rupee terms is up by 50 times from 1990 to now. So GDP is up 50 times, and the Nifty is also up 50 times in 30 years. It's a compounding of about 13% in rupee terms. But it's no coincidence that there's such a high correlation between the GDP and the Nifty. Nominal GDP, right? We are talking about nominal GDP in rupee terms. Because economic growth leads to corporates growing, and corporates growing leads to corporate profit growing, and corporate profit is what determines the level of the market. It's the same in the USA. If you look at the US markets, the Standard & Poor 5,000 profits in the last 22 years, the data is from 2001. In last 22 years, in dollar terms, their earnings, profits of the 500 companies in the Standard & Poor S&P 500 are up by about 4 times, 3.6 times. And the S&P 500 is also up by about 3.6 times. If you look at India, the profits of the Nifty companies in the last 20 years are up by about 10 times, which is again, even for 35 years also the compounding was 13%. For 22 years also the compounding is 13%. So you can see how over the long term this pans out, because in the short term there'll be cycles, one good year, one bad year. So you kind of tend to lose focus over the longer term picture. Of the longer term picture because you're looking at short term quarterly data. But if you look at the broad trend, 22 years of data, profits are up 10 times, Nifty is also up 10 times. GDP is up also similar, So there's a huge correlation between GDP growth, corporate profit growth, and the markets. This is a very crucial lesson that we need to keep in mind when we are looking at the markets for long-term investing. And since everything is rebased to 100, all these charts are rebased to 100. All the starting point is 100. So 100 has become 6,000, 5,800 here. The ones with this 100 has become 400, 367 and all that. And this 100 has become 1,000. So coincidentally, Nifty EPS also used to be about 80, 90. And now the expected EPS is about 1,000. So it's broadly, even if you don't rebase it to 100, the Nifty EPS is about 1,000 now. If somebody was asking. We have enough time. We can take questions. Only thing is, only if it's very relevant, because otherwise the flow will break.
So I'm putting my question, you can decide if
Sure.
Besides equity asset class, of course, you must be having as an investor manager of another asset class like real estate or commodities or something of last 22 years or 25 years. Is the correlation maybe more or less?
Actually, gold has done quite well, almost equal to Nifty in the very long term. But that's over the very long term. But gold has a very, step movement. So it does very well, then does nothing for 5-10 years. Then again, it does well. So Nifty is far more trending, I would say. Similarly, real estate also, it's done okay. There is some RBI data on house prices, which is done okay, not as good as the Nifty probably. But again, it is also very illiquid and it also acts in spurts. So there are 5-10 years of 4-5 years of very good run, then almost 10-15 years of nothing happening. Then again it runs. So it's not that smooth, I would say.
Thank you.
No problems. Okay. So one of the key questions, as we say, is that it's all linked to earnings. Whether we look at earnings at the market level or we look at earnings at the company level. If I make the same chart for Infosys or Reliance or any other L&T, you'll find the same pattern. That ultimately the share price moves in line with the long-term earnings of the company, long-term earnings growth. So there will be periods of overvaluation, undervaluation. So I was trying to explain. Do you have a pointer? Yeah, this may be a pointer. Yeah, I was trying to explain. This all rebased to 100. So the markets are moving up. 100 became 400. 400 went down to 200. The distance is rebased to 100, and so on and so forth. So there are these huge periods of overvaluation, undervaluation. When you're growing earnings in line with the market, a market is going up in line with earnings. This was a dream period, by the way. Remember, 2002 to 2007-8, where Nifty earnings actually grew by almost 30-40% compounded for 4-5 years. So that was a period of huge global growth where commodities were doing well, where infrastructure was doing well, huge investments were happening, exports were booming, emerging markets were booming basically. So in here, even though the Nifty went up from 100 to 400, the earnings were also keeping in pace. So if you see the earnings and Nifty levels almost were the same, then there was this slowdown where Nifty corrected very sharply. Earnings did not fall that much. So this was a period where I would say there was huge opportunity to buy. There was a lot of undervaluation that happened in the market. Then, of course, the market shot up, caught up again, where both the Nifty and the earnings are at about 500. Then broadly again, markets are going in line with earnings. Then there's a huge correction. And then there's a huge uptick till last year, I would say, where there was a period of overvaluation. But again, what happened is that because the global economy has done well, and because local economy and especially Nifty corporates have done well, and of course there's a dichotomy there where the small companies are not doing that well, the large companies are going larger. But as far as the listed companies are concerned, there was a huge growth in profits in the last 2-3 years. That's why again you can see that there is some amount of overvaluation. It's not that much. So then Nifty always, the market always goes through these phases of undervaluation and overvaluation. But long term, mota moti, it gets there as long as the companies keep on delivering earnings. And we've also seen that. What do you mean by valuations? Is you can use various ratios like price to earnings, price to book, EV to EBITDA. There are many ways of looking at valuations. But broadly speaking, if the market expects or if investors expect companies to deliver higher growth in the future, or countries like India to deliver higher growth in the future, then those multiples will be higher because markets are always discounting future earnings, future profitability. So India has been consistently delivering higher returns, and the world and investors are expecting India to continue to deliver high returns. That's why India's valuations have always been at a premium to the global market. So I get really irritated when those foreign brokerage houses come out with reports saying that India is trading at a premium to emerging markets and India is trading at a premium to the world markets and all. I said, bhai, you look at 25 years, we have always traded at a premium because we always delivered superior growth compared to all the other countries in the world. And we have data to prove that. If you look at the very long term, I've taken a smoothening 5-year CAGR of a 5-year average of GDP for the world. China, Europe, and US and India, of course. The red one is India. So if you look at the history of the last 40 years, which is, and this is really long-term data, except for China, which is the topmost line, India has always been delivering faster GDP growth than all the world. The black one is the world GDP growth. The world GDP growth on an average has been 2-3% per year. India on an average is about 6 to 7%. China, of course, was about 8 to 10%. And Europe and all like 0.5%, 1% average, 2% average kind of a thing. So, I mean, if India is trading at a premium, why is anybody surprised? Because for 40 years, we've delivered faster GDP growth rate than all the world except China. And if you look at the last few years, China has peaked out. And China is actually now coming down, whereas we are holding up. We can ignore the last bit because it's the COVID effect. So you can, but if you look at the data till 2020, in fact, in 2020, India's 5-year GDP growth rate became almost equal to China's. So China, we maintained our growth rate, but China decelerated because it's pretty much done its whatever boom of investments, etc., that needs to be done. So as we speak, probably India will continue to be the fastest growing economy in the world, at least for the next 5, 10, 20 years, given our demographics. And I have a lot of data on demographics. If you have time, we can look at that. But broadly speaking on demographics, 2 things to remember. For the next 20 years, India will add 20% of the global workforce. All the countries which are adding workforce are reducing in the incremental workforce addition is reducing. So India will add 20% of the global workforce in the next 10, 20 years. So for the foreseeable future, India will be the largest supplier of labor in the world. Now, whether we have the infrastructure and policies to give jobs to the labor, it's a different matter. And that's another big topic. Government is doing a lot of manufacturing. But the point is that we are the largest supplier of labor pool for the world for the foreseeable future, for the next 10, 20 years. So that is one. For the next 10 years, in the next decade, basically, whatever global GDP growth is happening, 20 to 25% of that growth will be because of India. Okay, so India's labor pool will supply 20% of the world's labor for the next foreseeable future. And for the next 10, 20 years, India will be the largest contributor, maybe India and China equally, to the global growth rate. So one fourth or 1/5 of global growth, GDP growth, will come because of India. So it's no surprise that you are seeing a lot of interest from foreign companies to invest in India, because now there is no other large credible market left in the world. China is now perceived to be a hostile country. So there's no other large economy in the world where multinationals can invest for future growth. So growth wise, labor pool wise, I think these are not changes which anybody can change. Whatever happens in Barakot or Israel or Ukraine, the fact that we are going to add 20% of the labor pool of the world is not going to change. So these are irreversible, unstoppable changes that's happening to the world. So India versus the rest of the world, we have consistently grown higher. And higher growth leads to higher performance, as we have seen. So as long as our GDP continues to grow, if you look at the last 20 years of performance, and a lot of you must have also been impressed by the way Nasdaq has done over the last 10 years. So Nasdaq has been the best performing market. I think the US technology space has been the best performing space to be in the last 10 years. But if you look at the even longer term picture, 10 years before that, so if you look at the last 20 years, India has done as well as Nasdaq also. Forget US. US is the blue one. And these are dollar returns. I'm not comparing rupee to dollar. These are dollar to dollar returns. So in the last 20 years, India in dollar terms has grown from 100 to 800 in the last. So that's about probably, I would say, 7-8% CAGR returns in dollar terms. Indian market. Nasdaq is similar at about 600-700. So CAGR mein zyada farak nahi padta. The US is up only 3 times. The MSCI China, if you see, is up only 4 times. China actually has really underperformed in the last 4-5 years as investors are pulling money out. Local investors are also not confident about their country, and foreign investors are also not confident about China. Nobody trusts China anymore. So if you look at the gray one, which is China, this is China. Chinese markets they were keeping pace with India till about 4-5 years ago, but now they are horribly underperforming. Nobody wants to be there. This is US, and this is of course Europe, and this is the average of the whole world. So the world markets are up about 2.5 times. So in 20 years, India is up by about 8 times in 20 years. So it's very simple. As long as we deliver GDP growth rate, our markets will continue to outperform the global markets. And paisa ko kheenchta hai. As long as we keep delivering higher growth, money will keep coming. So I don't see any reason why foreign money should not continue to come to India over the longer term. There'll be years where there'll be minus, there'll be years there'll be plus. But broadly, FDI and FII money has to come into the country because there is no other big market left to invest, a big quality market left to invest. Earlier, it used to be this term called BRICS. I don't know how many of you are aware of BRICS. Are you aware of BRICS? Yeah. So Brazil, Russia, India, China. People used to add Indonesia also. Now, Brazil is holding up, not too bad, but it's not as large as India. Russia is gone. China is gone. Bacha India. So that's what I was saying in the beginning, that India has always traded at a premium. So if you look at the PE, price to earnings ratio, which is today's earnings, so today's Nifty divided by the historical earnings, it's at about 22 times. As I was saying, markets are at, Nifty is at 20,000, and I was telling you the Nifty EPS is about 900 to 1,000 rupees. And if you look at the PE of the rest of the world, for example, blue one is again US, red one is India, and black is the world average. World is at about 18, US is about 21, India is at 22. But if you look at the red line, it's pretty much always been above the blue lines and the black lines. So India has always traded at a premium to the rest of the world. The premium has varied, of course. For example, here the premium was almost 50%. Then after the global financial crisis, when everybody corrected, we corrected more. So we went to a discount. But the average is about, always been about 1.2, 1.3 times the global market. So 20% premium we've always traded at. Recent peak was about 1.5. US has done very well. US earnings have done very well. So markets have kind of corrected a bit, relatively speaking. So we are at about 20-25% premium to the market, but utna raha hai hamesha. So it's nothing extraordinary that we are too expensive, etc. So some of the big drivers that I always want to highlight, again, since we are talking long term, is the structural positives. So there are certain endowments that India has, and these are, some of them are because of India's position, because of India's population, and some of them are because of government policies and politics also. One big one, which is basically we have the 6 Ds as Newama has coined them. Deglobalization. Deglobalization means earlier supply chains were globalizing, so multinationals were thinking of buying everything from the cheapest source, and typically that was mostly China and some countries like Vietnam, and India was not perceived to be a big exporter because we had a good domestic market also, so our exports were limited. In fact, our share in global exports is like less than 2% of trade exports, which is too low compared to the size of India. But typically China took the lead and they grew the hell out of themselves, and they become the factory of the world. But now, because of COVID, companies have realized that it's too risky to put all your eggs in the China basket for global sourcing. So they are looking at other locations where they can de-risk, and local politics and local job creation is also working now in the US, in Europe, where they want to strengthen their own manufacturing. So deglobalization is now happening, where companies are either trying to source more locally or diversify their sources of procurement into countries like India. So one big advantage that we have is that, as we mentioned, we have the largest labor pool in the world after China, and we are adding more workers every year than any other country in the world. So India is gradually becoming a natural selection for global outsourcing because of deglobalization, I would say. Deregulation, of course, we started in 1991 with Manmohan Singh's reforms, opening up of various industries, delicensing, etc. And I think that trend has continued over the last 20-30 years, where rules and regulations are gradually being made simpler, ease of doing business. Of course, there's a lot to be done, long way to go, but it's much better than what it used to be, especially with digitization, one window clearances, etc. And a lot of states are now competing with each other, laying out the red carpet for manufacturing. So we see healthy competition between states as far as labor laws are concerned, giving subsidized land, etc. are concerned, quicker clearances are concerned. So I think deregulation is again something that is working for us. Debt. India as a country is not leveraged very heavily. Households are not leveraged very heavily. Corporates are not leveraged very heavily. And the country is also not leveraged very heavily. All our debt is basically internal debt, domestic debt. We have very little external debt. So, the risk of foreigners pulling out money from the debt markets and destabilizing the banking system is very minimal for India. So we are a very under-leveraged country, which is good because there is a lot of scope to leverage and grow faster. When a country wants to grow faster, or when a company wants to grow faster, equity is of course there, but debt helps in accelerating that phenomenon, and we have enough capacity to take on more debt. So to that extent, I think there's a long runway of taking debt. Demography we talked about. Democracy, again, the largest functioning democracy in the world, very attractive to investors. There is justice may be slow, but there is rule of law, there is transparency in rule making, and digitization. I think digitization is something that I've added, and that is something where India has actually taken a lead in the world. So the kind of infrastructure that we have created for Aadhaar, and using that banking accounts, and using that direct benefit transfers to the poorest of poor, and Aadhaar is now being used for everything from directors, database to corporate databases to GST and everything. So the way we have linked our entire income tax, GST, Aadhaar system, and made it, and of course now the UPI payment system, it's completely revolutionary, and we are now exporting our UPI services to rest of the world. So I think digitization is something that we have taken a lead in. The India stack that we have built on the UPI layer is mind blowing. It's amazing, and countries are actually waking up to see what we have done. I think India and Singapore have already started UPI based connectivity. That is one, and more countries are looking to use this infrastructure to make things more efficient. The biggest threat, of course, is to multinational like Mastercard and Visa, where the 2-3% charges that they kind of take for nothing is under threat. So that lobby is working aggressively to delay the inevitable as far as possible. But this is a revolution that India has created on the payment system. So these are the natural strengths that India has, which we call the endowments. And then because of these endowments, we have a lot of opportunities. So manufacturing is something that we have not even scratched the surface on. As I said, our share of services exports in the world economy is about 4%. Our share of goods exports in the global economy is less than 2%. So we have a long way to go as far as goods exports are concerned, manufacturing is concerned. New energy is something again where India is taking a lead. All the big houses, Tatas, Ambanis, Adanis have announced massive plans for green energy, which is solar, mostly solar. Of course, second will be wind, and using that to produce hydrogen, green hydrogen, and using that to make sure that our oil imports basically go down, our energy requirements are met by renewables rather than this. And it's not only for meeting those Paris Accord targets. It's actually going to be much cheaper to produce green energy in India compared to any other source, and India is again taking a lead in that. Urbanization is, of course, we can see real estate is a sector which has the largest potential to create jobs and GDP growth. Real estate and infrastructure, because two things happen. One, when you create real estate, when you create infrastructure, it creates capacity in the economy, right? It creates future capacity to produce more efficient factories, to produce more efficient logistics. That's one. Second is, when you're building that infrastructure, that itself creates a lot of jobs. So real estate and infrastructure are the two segments which have the maximum potential. In the last 1 year, I'm beginning to see some movement, significant movement in the real estate space. And infrastructure is something that we will talk about. The government is doing a lot on. There is also this whole trend of premiumization of consumption. So if you look at the economy today, I would say it's okay, not that great, because while the headline numbers are looking good, you can see a clear K shape in every segment that you look, whether it's a TV or a car or even a service for that matter. It's the premium segment which is growing faster. So the growth rate of Mercedes cars in India year on year is much more than the growth rate of the basic Maruti car. And even within Maruti, their SUVs are selling more than the base version. So there is a trend towards premiumization. So I think it's the upper layer which is doing better, and the lower segment is yet to pick up. Our hope is that in the second half of this year and going forward, the rural economy should also start kicking in, and that should lead to the next leg of growth. We'll talk about that later. But in general, there is a premiumization. DLF, when they launched the project, I think the flat size ticket size of 4 crores or something like that in Gurgaon. They sold 8,000 flats, 8,000 crores worth of flats in like 15 days. So everywhere you look, the premium segment is doing very well. And that is something, there is an opportunity and there is a threat also, I would say. Equity savings cult, again, in the last 3 years has exponentially increased. The number of SIPs that are being created every month, the number of brokerage demat accounts being opened every month runs into 1 to 2 million every month. So 10 to 12 lakh people every month are opening brokerage accounts. maybe the amounts are not very large, but when you have 10 lakh accounts opened, even 20,000 rupees account makes a lot of difference to the market. So there's a lot of equity money coming in, F&O money coming in. I'm very scared about the F&O space. But the point is that people at least now aware and brokerage accounts have been opened. And technological disruption that we said, discussed about as far as UPI, etc. is concerned. So as we speak, India is broadly where China was in 2007. If you look at the nominal GDP numbers, or if you look at the per capita numbers, etc., we are broadly where China was in 2007. In 2007, China was at a per capita GDP of about $3,500, and we are currently at around that same level. Sorry, the same level, as you can see. China doubled it in like 5 years, 4 to 5 years. We probably will take a little more, about 8 to 9 years to do that, but we'll get there. Because we can't have that kind of ruthless execution as China has. So we'll get there, but by 2030 we should be at China's level, where China was in 2011, so to say. So I think India will catch up, and China's demographics inevitably is going down. China's population peaked out last year already. So now they are actually degrowing population, and they'll continue to degrow their population in the next 20, 30 years. So the peak of China's population is past us. So China just cannot sustain 5 to 10% GDP growth rate. I think it'll be closer to 4 to 5%. And because our population will continue to grow at least till 2040, we will kind of take over that incremental growth from the rest of the world. So our population is our biggest asset. It can be a liability if we don't, do things wisely and create jobs. So broadly, again, long term, if you see India's GDP rank in the world, in 2000, we were just in the top 10. We were the 10th ranked, 10th largest economy in the world. Currently, we are already the 5th largest after Germany, and probably we have already overtaken Germany this year. So we'll be 4th largest. And by 2027, we'll be the 3rd largest economy in the world from the GDP size. In terms of equity market cap, we were 15th ranked in the world in 2000. In 2010, we became 8th. In 2020, we became 7th. And by 2030, we'll probably number 4 or number 5 in terms of market cap. So any global investor who wants to build a global portfolio will have to allocate more and more to India. Again, money begets money, right? The larger you grow, the more money you will get. Because benchmark में क्या होता है, 10% Infosys है, 10% HDFC बैंक है, तो किसी को निफ्टी में पैसा इन्वेस्ट करना है तो 100 रुपए में से 10 रुपया तो HDFC बैंक में जाना ही है, 7 रुपया Infosys में जाना ही है, 10 रुपया Reliance में जाना ही है. So similarly, when a global investor is making a global portfolio, the largest India's market cap is, he'll have to put more money into India, even if you want to be neutral on India. And most of the investors are overweight. So money begets money. So that virtuous cycle will keep on happening, and we should continue to get the global money into the country. So as I said, the foundation for the next 10, 20 years is very strong. We just need to make sure that we don't score self goals, which we do from time to time, but hopefully not. So that was the very long-term picture. As Mahesh said, paisa to India mein banna hai. And that's, I tried to put as much data as possible, less sentiment, more facts, and the facts are in favor of India. So that's where we are. Coming to the overall shorter-term macro situation, just a few slides on this. As I was mentioning, as a country, we are not leveraged. So we have not overextended ourselves as a country. Even companies are not overextended. There may be some in the MSME space which are there, but the large corporates are basically not leveraged to any great extent. And even households are not that leveraged, I would say. So if you look at corporate debt to equity in the last 5 years, actually fallen quite a lot. Debt to equity was almost 1:1 in the last decade. about 93%. That's where the peak of the investment cycle was, when all the corporates were setting up power plants and infrastructure projects and steel plants and all. And then we know a lot of them failed, and we had the debt, NPA issues in the banking system, etc. But now all that's past us, and corporates have actually brought down debt hugely from almost 1:1 is now almost 1:0.6. So a lot of deleveraging done by corporates. The balance sheets have been cleaned up. They become more efficient, and they now have the capacity to now start the next investment cycle. Even India as a country, this is the change in the debt to GDP from pre-COVID to post-COVID. So from 2020 to 2022. So if you look at most countries, they spent so much on COVID countermeasures like fiscal stimulus. US gave checks of $500 to all its citizens for 1 year, then gave another check of I think 600. So a lot of fiscal stimulus was done by a lot of countries, and because of that, most of the countries saw in 2 years from 2020 to 2022, they saw a significant increase in the debt to GDP, right? So China has seen almost a 50% increase in the debt to GDP in 2 years. Similarly for Indonesia, all emerging markets, Brazil, even US saw an increasing debt to GDP. But India was the only country where we did not spend that much. We did things in a more sane fashion. We gave free food to the needy people. So we did not kind of use a shotgun approach. We use a very granular approach to make sure that the subsidies and the benefits go to the relevant people and not in a mass scale, so to say. So we are the only country where the debt to GDP in 2 years actually went down. Because GDP continued to grow, debt did not grow that much, so the ratio actually came down. So we are actually in a much healthier state than pre-COVID, and that's because of the very sane policies by the government and the RBI. This is for the corporate sector, this is for India, and this is at the household level. Even at the household level, debt to GDP has actually gone down, because even households in the COVID time have not borrowed that much. Most of the borrowing that is happening, I would say, if I look at the data, is happening on the consumption side, on the personal unsecured loan segment, which is a bit of a risk, I would say, to the system, but it's not so big that it can destabilize the whole system. But if you look at the overall household debt, actually it's come down, household debt to GDP. So even households have not used the COVID period to kind of overextend themselves. They cut down consumption, they saved more, and basically made sure that they survived the 2-3 years of COVID. So I think as a country, we are in good shape as far as leverage is concerned. Even banks are in great shape. In the last 6 years, banks have raised a lot of capital. Banks have cleaned up their NPAs either by writing off or by recoveries. And if you look at the net NPA ratio, it shot up to as high as 6% of the system, and now we are down to about 1%. So bank balance sheets are also very clean and very safe, so to say. Which means that if you put the two together, corporates don't have leverage. Banks have the capacity to borrow, to lend, which means that when money is required, that's not a problem for any company. The GST and other tax reforms, etc., have also ensured that the economy becomes more and more formal. So the unorganized sector is under stress. It's very difficult to now, more and more difficult to do business in cash, etc. And more companies are forced to come to the formal system by reporting on the GST, etc. So if you look at the share of listed companies in manufacturing GDP, it's actually gone up quite sharply in the last 3 years. Because now everybody wants to do business with the listed companies or the organized sector only, or the larger companies, because of the compliance, etc. became tougher. So it's almost gone up from 24% of manufactured GDP to almost 32%. So 8% increase in the market share of large corporates in the manufacturing GDP compared to the small corporates. So that's a big change where we are seeing an increasing formalization of the economy, and that will lead to higher tax collections, and that increases the government's capacity to spend on the relevant areas, whether it's infrastructure or social spending, healthcare, education, or even defense for that matter. More formalization will mean better tax collections and better spending capacities. So I think overall corporate India, banking system, households are in good shape as of now at the macro level. There are pockets of concerns, which is basically in my view, on the consumption side, and I would say on the small cap and mid cap size, where the concern is not so much about growth, is more about valuations. So if you look at the large caps, which is the Nifty, we looked at the PE. It's at about 22. The average is about 20 on a historical basis. So we are not that expensive compared to the historical scheme of things. Yes, there was a time where we became too expensive, and we did see that almost for 18 months, the Nifty has not given too many very great returns. And that's because there was a time correction required. Nifty had gone up before profits. Now profits have caught up, and we are at a normal zone, I would say. The second thing we need to also watch out is the opportunity cost. When an investor is looking to invest in the markets, the opportunity cost is putting money in debt, and interest rates are going up, as you know. But if you look at the overall situation, the earnings yield of the Nifty, which is the inverse of the PE, so when the PE is about 20, 22, the earnings yield becomes about 4.5%, which is where we are. And when the PE goes down, of course, the earning yield become very attractive. So when you have a situation where earnings yield, the PE becomes too low compared to bonds. So this is the difference between the bonds and the earnings yield of the Nifty. This is where I would say it's a screaming buy zone, where you should sell your bonds, break your FDs, and put money into equities. And when things are too expensive, this is where you should not put money into equities compared to fixed income assets. So right now we are in a little expensive zone, but again, I would not say it's too expensive. So Nifty on its own is not that expensive versus bonds also. It's not that expensive anymore. A little expensive, but I would not say anything to fear about. The risk is that yields are currently rising. Globally, if you look at the bond yields, in the US, especially if you see, bond yields have gone up from almost 0 to 0.5% to 5%. And these are levels that they have not seen in like 20, 30 years. Okay. The mortgage payment, the mortgage rate for a 30-year mortgage in the US, and in US, 95% of the mortgages are fixed rate mortgages, 30-year fixed rate mortgages. That used to be about 2.5%, 3%. That has gone to almost 8% in the last 18 months. So rising interest rates is going to put a brake on the US economy and the global economy. And we can see clearly US has gone up very sharply. Europe has gone up. Even Japan has gone up. So everywhere interest rates are rising because of inflation. वो हमने देखा ना, the debt to GDP सबने इतना बढ़ा दिया था कोविड टाइम पे, तो वहां पे consumers have gone mad and they are consuming. First they consume goods, now they are consuming services. There is no labor available there, so inflation is going up everywhere, and now they are paying the price of that overstimulation that they did. India mein bond yields are at high, but there's nothing out of the way. So our bond yield was 7% 10 years ago also, 10-year bond yield. It's at 7% today also. So we have not done anything extraordinary. Stable sort of. It's stable only, yeah. It's all stable. So for us, 7% bond yield is not a big deal. But in the rest of the world, this is a situation that they have not seen for 20, 30 years. These kind of interest rates, they have not seen for 20, 30 years. And that's the biggest risk to the global economy, that high interest rates will curtail consumption, investments globally, not in India. But वो बाजू का घर जलता है तो हमारे में गर्मी तो होती है, so that is the global risk that we have as far as the markets are concerned. And you can see as yields are rising, GDP growth rate estimates are coming down. So this is a chart where I'm showing the calendar year 24 growth rate expected. So Bloomberg does a poll of economists and analysts, and right, for example, if you had asked, the poll last year was saying that the US economy in 2024, which is next year, will grow by about 2%. That was the estimate. As interest rates have started rising and slowdown is happening in the US, now the consensus is that from 2%, the growth is hardly going to be 0.5%. Okay, so as interest rates are rising, people's expectations of growth rates in the US are going down. Similarly, for Europe, they were expecting 2% growth rate, and now for Europe, they are expecting less than 1% growth rate. So growth rate expectations have halved for the global major economies, I would say. India, again, because India is not doing too badly. India, we are expecting 6-7% growth. We are still expecting 6-7% growth as far as India is concerned. But rest of the world is seeing downgrades in the GDP growth rate estimates. And as GDP growth rate estimates go down, very simple, even earnings estimate go down. तो आप S&P 500 estimates earnings estimate देखें, तो for next year the estimates are getting cut. This is a survey 1 year ago. This is the estimate today. Similarly, world also it's going down. Estimates for all emerging markets are going down. For China also it's going down. So interest rates are rising. GDP growth rate estimates are going down. Earnings estimates corporate profit estimates are going down for the world. For India, GDP growth rate estimates is stable. Earnings estimates are also stable. We are expecting about next year about 17% growth, and the year after that about 12-13% growth in Nifty earnings. And that estimate has broadly remained the same. As I was saying, Nifty EPS estimate for 2024 is about 950 rupees, about 1,000 rupees, and next year it will be about 1,100 rupees per share of Nifty. So that is broadly stable. So India situation is fine. Global situation is not in favor, and yesterday's development of Israel is not going to help. That's a big event. So those kind of Ukraine geopolitical risk will also not help the global economic growth. The other thing that I am a bit skeptical about is that while we are talking about headline numbers, the headline acha lag raha hai, that FY24 we should grow at about 17% Nifty earnings, and after that about 12-15% earnings. But if you break up the earnings, these are quarterly numbers. Most of the growth actually has come because of banks and energy companies, commodities companies. So in the last 2 years, the earnings growth has come from financials because banks have done well. They have grown their credit, net interest margins have been good. So banks and financials, which are almost 36-37% of the Nifty weight, have done well, and that's driving the earnings growth. On energy, it's companies like Reliance, ONGC, HPCL, BPCL, which have done well. So those companies have delivered good growth, and that's where the growth has come from. If you remove the energy and banks pack, then the growth has not been that great, right? So sorry,
It was hardly.
it was hardly. So yeah. So overall EPS growth was 20% for the Sensex last quarter, and if before that 18%. So good growth on a headline level. But it was not so great in the other segments. In fact, the other segment, उसमें सब आ गया फिर FMCG, auto, industrials, your paints, everything, all those companies. There the growth was not that great. So that is something that we are hoping that in the second half, as consumption picks up after Diwali and the busy season, that should pick up. But so far, the numbers have not been that great in that segment. The other pocket of worry is in the mid and small cap space. So if you look at the valuations of mid caps, they are trading at almost all-time highs. So this is the mid cap index PE, and this is the ratio. This is the difference between the mid cap PE and the Nifty PE. So mid cap PE typically is about six higher than the Nifty on an average, I would say. But right now, it's a completely different level altogether. So mid caps are trading at an all-time high premium to the large caps. So that is one thing to be worried about, that valuations are not on your side in the mid and small cap space. This is for the small cap index. Similarly, small cap index PE also is at its high, and small cap over Nifty is okay-ish. But again, something that doesn't give us good comfort. The craziest part is this. Sorry, yes.
So you can give this, the precedent is wrong.
Yeah. Now, let me just finish this slide.
Yeah, just like.
The craziest part is in the even smaller stock. There is an index called micro cap index in the Nifty. In the last 6 months or 7 months, is up by 60%. This is the micro cap chart. There is a BSE SME IPO index. That index is about 300% in like a year. So these are, I'm good that people are making money, but it's a source of worry because things are a bit crazy out there. Yeah, so I can stop here.
Okay. Just
Break.
break for 10-15 minutes.
Sure.
Our ICI president, vice president, and CCM. They are joining virtually. They consented to come here, but they got some urgent meeting that they had to attend to. So they're joining virtually and addressing. So let me just let them connected. So
This lecture will be continued after 30 minutes.
हेलो या पीयूष जी ज्वाइन स्टार्ट कीजिए या मैंने उनको रुकवा दिया Request everybody to please keep sitting.
Purviji? Oh, congratulations, sir. Congratulations. Hello. Can you hear us?
I'll just do that. Voice
आपके आपके इधर से अनम्यूट है सर आवाज नहीं बात कर लेंगे
Yeah, can you hear us? Can you hear? बोल रहे हैं ना?
देख रहे हैं लेकिन आवाज नहीं आ रहा
कुछ बोलिए
बोलिए ना आप उधर से कुछ
बोल रहे हैं ना? We are saying no. मुझे आवाज तो आ रही है ना?
नहीं आ रही
Do you hear us?
आगे आ रहा है
yeah. So you're live.
Shall I? Purviji, can you listen us?
Live, yes. Audible.
Yes. Thank you very much. Esteemed members of JB Nagar Study Circle, Convener Purviji, Deputy Convener Vijeta ji, past conveners. We have a pleasure of President and Vice President of our institute joining with us today live. Without taking much time, I would request first Vice President Honorable Shri Ranjitji Agarwal to kindly address the gathering and welcome him. Of course, I would welcome both of them for addressing us live to this JB Nagar Study Circle, which is one of the largest study circle in the city of the Mumbai. And incidentally, when we are celebrating 75 years, JB Nagar is celebrating 25 years of its existence. So I would now request Honorable Vice President Shri Ranjitji Agarwal to kindly address the gathering.
Thank you very much, Piyush Bhai, Honorable our President Aniket Talati, Purvi ji, the convener of the study circle, Vijeta ji, Deputy Convener, all the respected members of this study circle. It's very heartening to know that two ladies are leading this study circle, and if you see our profession also, we have 4 lakh members and 8.5 lakh students. Out of 4 lakh members, 29% member are women members, and out of 8.5 lakh students, 43% of the students are girl students. So our profession, this gender equality is fast approaching without any reservation, and that is the beauty of this profession. We are in Nasik, and we were supposed to come to the study circle physically yesterday, but we have very hectic schedule yesterday in Mumbai, and today we are Nasik. So today is not the right time to address, but whenever we will next in Mumbai, we will definitely come and address all the members physically. So once again, thank you very much, all of you, for connecting us virtually for some point of time and giving us a chance to address you. Thank you very much.
Thank you very much, Vice President sir, for addressing us. Now I would request Honorable President Shri Aniket ji to kindly address the gathering.
Thank you very much, Piyush ji. The Honorable Vice President seated next to me, Sri Ranjit Kumar Agarwal ji, very dynamic Central Council member from your own study circle, who has always been discussing about in the council the issues that study circle faces, especially all the practical real life examples that he has of members from Andheri and JV Nagar study circle, the practical issues. They are always, he's one of the first people to raise them in the council. Sri Piyush Sajad ji, the convener, deputy convener, all the past conveners, senior members, ladies and gentlemen. Apologies that we are not able to be with you in person today, as we have to be in Nashik. Today we are in Nashik, and in the evening we will be proceeding for Delhi. We have a very important council meeting tomorrow and day after, because of which we need to be in Delhi today evening, and therefore could not be in Mumbai this morning in your midst. But let me assure you that we will definitely be coming to JB Nagar in person, in physical, and be there with you, try and interact, because though virtual after pandemic has become the real norm of today and the new normal, but nothing compares to physical meeting and interacting with all of you in person. So we definitely will be there in person. But I'm delighted to note that as the institute celebrates 75 years of trust, and on 1st of July, we entered our 75th year with the gracious presence of the Honorable President of India, Draupadi Murmu ji, and in the same breath, JB Nagar Study Circle. I did my articleship from Mumbai, and since then, JB Nagar is known to me as one of the most vibrant study circles with so much contribution for the cause of the profession. And this year, you are celebrating your 25th year. I think the wonderful efforts that all the past conveners have put in making sure that the brand of JB Nagar Study Circle is resonated not just in Andheri, not just on the Western line or in Mumbai, or not just in the Western region, but across the country. I don't think there is any speaker who does not know about JB Nagar Study Circle. And that speaks volumes, that despite of the fact that there will be branches where some speakers may not have been, this is one study circle which everybody aspires to be and speak about. The quality of interactions, the topics that are taken up. I regularly follow up the emails that I receive from the study circle with regards to the discussions that you are doing. And let me tell you that they are extremely contemporary and also very relevant. And today, as we speak to you from Nashik, we have a national conference here. This year, especially post the pandemic, we have seen tremendous activity, and the thirst for knowledge in our membership has been immense. I was told by Piyush ji that every Sunday, whenever you gather, the minimum starting point is 200 members. And I'm so delighted that even today on a Sunday morning, the entire hall in front of us, we can see is totally full. And that is compliments to all of you for your commitment towards this study circle, your commitment towards ICAI, and your commitment towards continuous learning. At the Institute, we are continuously working to see how more and more opportunities can be created for our members. We recently completed a very important exercise of KYM, or Know Your Member. I would urge the study circle and all its members, almost 90% of members have already completed their KYM and paid their membership fee. We have extended the deadline in view of the requests that we were receiving, and now 31st October is going to be the last date. But my request to all of you, please don't treat this as an exercise which is time consuming or energy consuming. This is such an important exercise that after so many years, the Institute is reaching out to you to get your updated details. And as a result of this, you will be pleasantly surprised to note that thousands of proprietary concerns, people who created proprietary concerns and then moved forward, but did not remember to update with the Institute, they have now closed down. So many branch offices which were opened hitherto, but people could not update their addresses with the Institute records for various reasons. They have now all come and updated their branch. And what this has resulted into is accurate data which the Institute has in its possession, and which will now be transmitted to RBI, to CAG, and to all stakeholders to ensure that each one of you, who's specially practicing, and your details are accurate, and of other firms which are being submitted are also accurate, so that you are compared at the right level. Also, I'm delighted to mention to you that at the international front, ICI has been moving forward. 2 days ago, I was in the CAPA meeting, and there too, the kind of recognition for the Indian accounting profession and the country of India is truly immense. We now have the presidency of CAPA, and we also have a board seat, which is currently occupied by me as the president of the institute for a term of 4 years. This only goes to show the kind of impact the Indian accountancy profession is having internationally. And I'm sure as the time goes forward, with the success of World Congress, which was organized in your very own city of Mumbai, we are now moving forward with a very important international conference in the form of GLOPAC, which is happening on 24th, 25th, and 26th of November in Gandhinagar, Gujarat, where we will have the who's who from the entire industry, bureaucracy, as well as from the regulators, deliberate and discuss in the presence of international participants, the Indian accountancy profession. So I invite all of you to be a part of this wonderful opportunity that the Institute is presenting in the form of GLOPAC, and look forward very soon to meeting all of you in person. Thank you very much. Jai Hind, Jai ICI.
Thank you very much, Honorable President, sir, Honorable Vice President, for addressing us live. We will look forward to you for your physical presence in JB Nagar Study Circle. And Purvi ji, I would request you to please propose a formal vote of thanks for Honorable President and Vice President.
Thank you, Piyush ji. On behalf of the entire JB Nagar Study Circle, I would like to propose a hearty vote of thanks to Honorable President, Vice President, sir, and Central Council member, Piyush Chhajar ji, Aniket Sunil Talati ji, and Ranjit Kumar ji. Thank you for sparing your valuable time and addressing the members today here. And thank you for elaborating the importance of GLOPAC also. I'm sure many would be interested in attending. We'll be sharing the GLOPAC brochures also with the members. And looking forward to having you here physically soon. And thank you. Thank you so much. Mihir ji.
Was to come here today, but unfortunately in Nasik mein unka urgent aa gaya. So I decided to specifically told that I will speak from there.
Okay, so we talked a lot about the broad market and the broad trends. There are a couple of things that, since we have time, I would like to spend some time on, which is on manufacturing and infrastructure. So the India export story so far has been mostly on services exports, IT services exports, and that's done extremely well. So we have the largest market share of services exports globally, and that's because of our IT, and that's only because no government is required there. So anybody with a high-speed connection could get connected to the US and start exporting software. So it has happened in spite of the government, not because of the government. I think the only thing that government did good is to stay away from it. And that's the reason why we are so successful in IT services. And now we are of a global thing. Similar, I think, since we talked about demographics, is this connected? Yes. So since we talked about demographics, we are adding 1 to 2 crore of people, young people, every year to the workforce, and those guys need to be employed. Otherwise, there is a big issue of social aspirations, social stability, and software services cannot create, or BPO, KPO, sab mila lo, so they cannot create more than a few lakh jobs per year. It can be 5-10 lakh jobs or something like that per year, but they cannot create 1 crore jobs per year. Those kind of jobs have to come from physical manufacturing, infrastructure, real estate, textiles, those kind of things, and essentially you need people to be physically employed, not only in services. Of course, the service sector there are other things also like hotels and travel and tourism and all, but that is already there. The big delta has to come from manufacturing. The demographics of India need that, and as we saw, the natural forces of the world are in our favor to take it. It's for us to take it, basically. If we don't be successful in manufacturing exports, it's nobody's fault but our own. And I think the government also now realizes that in a big way. So many measures over the last last few years have all gone to supporting private sector capital expenditure. But we saw that there was a big investment boom from 2008 to 2014, and then there was a NPA cycle. So banks became conservative, corporates became conservative because they burned their fingers. So we saw that corporates deleveraged, they were risk averse. Nobody wanted to take the risk of a big project anymore. And so you saw a big drop in private sector investment. Since 2015, 16, 17, I would say, the government has kind of been proactive in doing whatever it can to keep the economy stimulated. So it has done a lot in terms of spending, especially capital spending. We can see a lot of activities, and we have numbers to show that a lot of activity happening in roads, railways, infrastructure creation. So whatever the government can do on its own has been doing on the fiscal side, both state governments and central governments. But the private sector capex has not really kicked off. And so the government is doing a lot on the regulatory front, policy making front, making schemes to make sure that investments in manufacturing and infrastructure from the private sector start kicking in. And that can be local investment or multinational investment. We don't mind that. Because we are far behind. If you look at the top 10 countries by share of global manufacturing output, China is 1/3 almost. China is 1/3 of global manufacturing. I mean, that's mind-boggling. India is 3%. India is 1/10 of China in terms of size. As a country, as in terms of population, we are equal to China. Now we have exceeded China. But in manufacturing, we are 1/10 of China. So there's a wide open canvas for us. Whatever we do over the next 20 years is going to be less as far as manufacturing is concerned. Even if you look at countries like Korea, India's population is 140 crores. Korea's population is probably 4 crores. Yeah, Korea is Germany. Germany will be probably, I don't know, 10 crores or not even 10 crores. Germany's population would be how much? I don't know, 10 crores or so. Germany is more than India, almost double of India in manufacturing. So, India has really not done anything on manufacturing, especially on manufacturing exports. And that's where the big opportunity lies. Countries like Italy and all are 2/3 of India, France, etc., where the population is far lower. So government realizes that manufacturing is the only way to create jobs. So what are we doing about it? IT will continue to do well. So IT may 5-10 lakh jobs, and if you look at the associated services, maybe 20 lakh jobs are created by IT and related services every year, and that should do well. And now what's also happening post-COVID, a lot of multinationals have again started realizing that their own employees in the US or Europe, they don't want to work in San Francisco or New York. They are working from a small town in the US. So then they are realizing if he's going to work from a small town in the US, he might as well be working from Bangalore. So the COVID has actually accelerated the process of multinationals setting up GCCs, what they call Global Competency Centers. And these GCCs are different from a normal outsourcing to India because these are owned by them. So in the last 3 years, there's an exponential rise in global competence centers by multinationals doing not only IT software development, that is anyway there, but they are now moving their back office here. They are moving their data analytics here. They are doing a lot of the things which require highly skilled, scientists and engineers to India, and that's actually leading to a lot of growth in IT services. So it is expected that almost $35 billion of GCC exports can be of services exports will be added every year, which is a big chunk. Almost you can say 1% of GDP can be added due to IT services next year. So IT services success will continue, but it will not create the kind of jobs that are required for 140 crore people. So the government now plans to make sure that manufacturing proportion of GDP, which has been very constant. If you look at the last 40 saal se manufacturing is only about 15% of GDP for India, whereas for China it's 40%, 50% of GDP. So for India, we've just, while services has grown faster, the proportion of manufacturing actually gone down from about 17-18% to 15-16%. So it's not really done anything great. Now the plan is to now kickstart it and to get it to at least 20% of GDP by 2030-32. And for that, there's a host of things that we are doing. We'll just describe them in a little more detail. We mentioned about this. India's share in global trade has increased dramatically in the decade of 2010, decade ending 2010-11. After that, it's been stagnant because manufacturing share has been stagnant for India. So while we did manage to increase our manufacturing share in this decade, for the last 10 years, our share in global exports for manufacturing has not gone up. Services exports has gone up. So our share of services exports is now 4% of global, which is good. And we should aim to make sure that we reach at least that level of 4% of exports for the export market share on global trade for goods. So overall, we have about 2% market share for India in the global trade, but it's basically led by services, not by export. In fact, our export CAGR was only 2% for the last decade. Very, very low, very, very low. Well, services grew at more than 10-15%. This is I would say, a tragic chart. This chart basically, if you spend a minute on it, it shows the yellow dot is the percentage of the world's working age population by country. So India has about 17% of the world's working age population. China has similar 17% of the world's working age population, which is the right-hand scale. China's share in world export is 14%. India's share in global exports is, as we know, 2%. So our population, working age population is similar, but we are not using that population for manufacturing. And this is the gap that the government wants to bridge. For most of the countries, look at this. Japan is like 2% of the world's population and 4% of the world exports. Korea has hardly 1% of the world's population, and they have 3-4% of world exports. So, all these countries have done so well on manufacturing. And that's why they have per capita GDP of $30,000, $50,000, So in reforms, a lot of things happening. PLI, I don't know if you can see it, but there are a lot of measures in the last 4-5 years that the government is working on. Long way to go, but it's all in the pipeline. So PLI is of course being rolled out very aggressively, and that's, I think, one of the single biggest reasons for optimism on manufacturing, because PLI schemes is a good way of bypassing the WTO and the World Trade, basically the trade agreements, free trade agreements. And it also encourages production ramp up to be faster. Because earlier in the subsidy regime, what used to happen is people used to take subsidies and build capacities, but production was not happening necessarily. Here, you get subsidies only if production happens. So to that extent, it's a far more efficient way of doing it, and it's WTO compliant. So, and government has tasted initial success in a big way in mobile manufacturing. And based on that success, now we are rolling out across sectors now, and I'll go through the list of sectors where things are already happening. Labor reforms, state by state, it's a state subject. So many states are now aggressively pushing ahead with labor reforms. Land reforms is a little bit on the back burner. We have done great work on direct benefit transfer. On taxation, we have simplified a lot, I would say, both on direct and indirect plan. Gati Shakti is another one big time where the cost of logistics will reduce. So they are debottlenecking the roads, the ports, the airports, the railways, dedicated freight corridor, all and setting up of hub and spoke warehouses all over the country. A lot of work happening on Gati Shakti, which is not very well reported. The insolvency and bankruptcy code has helped, and of course inflation is kind of being handled in a rational way, so to say. So if you look at the PLI scheme, which is one of the big successes, and now we are talking about PLI in semiconductor manufacturing, in the circuit and microchips manufacturing, and I think the government is seeing that. In fact, it's like a very highly consultative process. If a company or a global company wants to set up shop in India, the government is actually going ahead and asking them, what do you need? So they are actually taking decisions quite quickly, and to make sure that all the big guys, especially on the semiconductor front, come to India faster than possible. If you look at Noida, Greater Noida, the kind of electronics manufacturing that is coming up is amazing there. Noida, Greater Noida used to be, house prices used to be, 2,000 rupees, 3,000 rupees per square foot, and they are going up very sharply because a lot of activities now happening on that side. And now with the new airport coming up in Jewar, there can be a lot more activity happening in that. The manufacturing is already very good, but a lot of other things can happen. So I think government is doing whatever it can. You already have existing schemes in textiles, pharmaceuticals, chemicals, automobile components, and these are good amounts. $18 billion of market size, and if you can create a good amount of jobs or investment in textiles, it can be the largest employer in the country. And India has traditional strengths in textiles and garmenting can create like literally crores of jobs, because it's highly labor intensive, especially women. It employs a lot of women. Even electronics, if you look at South India, the maximum work of assembly is being done by women, because they have natural dexterity, I would say. So a lot of job creation is happening for women. Textiles is another place where a lot of job creation can happen, not only for women but also for men. So textiles, PLI for pharma is already there. PLI for chemicals is already there. Auto and auto components is there. Metal product is already there. And the prospective, we are already talking about computers, electronics, optical products. So government is basically rolling out an open carpet. If you are going to invest in India, we can make a scheme for you as far as production link incentive is concerned. And that is creating a lot of demand for equipment, capital goods. So the teji that you're seeing, the bullishness that you're seeing in a lot of these small manufacturing capital good companies is because it's not L&T or Reliance setting up a steel plant or a cement plant of $1 billion. So if you look at announcements, the announcements they're not visible. But if you look at the order book of these capital companies, suddenly they are seeing a lot of orders. So it's a lot of medium-sized players which are investing to supply to the bigger companies. So a lot of the investment which is happening is not visible. But if you look at the order book of a lot of these small capital machinery manufacturers, etc., they are very healthy. So छोटे करके orders आ रहे हैं उनको. MSMEs are, especially the larger MSMEs, are doing very well. And some of the promoters which have corporatized and organized themselves better, companies with 400 crores turnover, 500 crores turnover, they are actually leading the charge as far as a lot of these investments are concerned. I mean, who knew about this Keynes or SGS Sharma, etc. till about 2-3 years back? But suddenly you realize there are 1,000-2,000 crore companies which were not listed, and now they are listed. So a lot of action happening on the medium size, I would say. Defense, government is doing a lot on defense production. Our total defense production local was about 85,000 crores till FY 2021. About 80,000 crores of defense manufacturing was happening. The government is now telling companies to produce more domestically, both the PSU defense companies as well as private sector. And again, the process of approval, etc., ordering has been made much more efficient. And we are now talking about doubling defense production in the country just in 2 to 3 years. If you look at exports, we were like nothing, like 8,000 crores of exports in FY 1920, 9,000 crores. The FY 25 target is 35,000 crores. So government is actually working with the private sector and the public sector entities to make sure that we start exporting from India defense products. And for example, in Armenia, we have been supplying a lot of missiles for Armenia, and I'm sure a lot of happening on the background since defense not much is publicly available. But you can see it in the share prices of the defense companies that a lot of future growth is being discounted, and that's because of these stated objectives. 85,000 crores to 1 lakh crores of exports. I mean, who would have thought India was going to be a defense exporter even 2 years back? If you look at railways, the government is pretty much in the last 2-3 years doubled spend on the railways infrastructure. From about 1,30,000 crores to 2,60,000 crores in FY 24, and it's going to go up by another 50% in the next 2 years after that. So complete, you can see it in the metros, the Vande Bharat trains. They are actually, I think they are talking about 200 Vande Bharat trains. They are talking about, I think, 50 odd cities being covered by metros, etc. So a lot of work happening on the railways front. And if you look at some of the pockets, for example, safety 2 times spending. Then you can see new lines construction 3 times increase in spending. So a lot of segments, they are rolling stock is almost again 28,000 crores to 50,000 crores of rolling stock. So a lot of segments, they are just doubling and tripling the outlays. So as I was saying, the government is doing whatever it can in the roads. Overall spending in the road sector from 97,000 crores is going to go up to almost 220,000 crores. So whatever government can spend, they are spending, and as they getting more taxes in terms of tax collections, they are spending accordingly. In fact, this was in The Economist, where they also observed that road and railway spending was about only 0.4% of GDP, 0.3% of GDP a few years back. Now that alone is about 1.6% of GDP. So half to 1% of GDP growth is coming just because of road and railway construction spending. So that's on the infrastructure and manufacturing part. So capital markets and fund flows, of course, you all know the way money is coming into SIPs, money is coming into insurance premiums, money is coming into demat accounts, brokerage accounts, money is coming into NPS, and of course the EPF has increased the allocation to equity. So I think naturally there is a core amount of flow every month that is coming to the equity markets, which is much larger than what it used to be 4-5 years ago. So there is a liquidity support for the market. I don't want to spend too much time on that, but basically all the charts are up as far as close to the domestic flows to the equity markets are concerned. This is the accounts, number of investor accounts opened on the left. SIP flows almost 15,000 crores, and so on and so forth. So yeah, so structurally, I think the Indian markets are in a good shape. You will see some volatility in the market because there is some concern on growth, inflation, and valuations in some pockets, as we discussed. But that is for probably traders to time it. I can't time it. But if you look at the bigger term, longer term picture, there's a lot of positives that we are in, and India will continue to trade at a premium to the rest of the market, so the rest of the world. That's where we are. A lot of the stuff I always put out on Twitter and LinkedIn, so you can follow me if you want to keep abreast of all the developments. And yeah, I think that's it from my side. Thank you.
Any questions?
Can you speak loud?
Yeah, I can.
Yeah,
What do you think? In one of the presentations, you have stated that the interest rate increase leads to the reduction in the GDP.
Growth.
Yeah, GDP growth.
Yes.
So can you just explain the correlation between the both of factors?
It's just that things become expensive, so expensive to borrow, right? And if your mortgage EMI goes up by 2 times, you're either not going to buy the house or buy a smaller house, right? Similarly, corporates, if they were planning to do some capital expenditure by taking borrowed funds, they will probably rethink the whole project. That's how it kind of slows down. Corporate property, it becomes expensive to justify a project, cost of capital, etc. Households, as I said, will credit card bills, monthly expenses, all get curtailed when you have borrowings becoming expensive.
And one question was regarding that PLI. I think it's more of a technical, but if you can just give your like inclusion of the introduction of the PLI is avoiding the WTO or something like that.
So in WTO, you can't give subsidies directly for exports. So this is nothing. This has nothing to do with exports.
Yeah.
The government is saying if you produce this commodity in this time frame, based on this amount of capital expenditure that you've done, this will be the subsidy that you get. Not subsidy. This will be the incentive they add. They are not saying if you export only, then you'll get. If you make in India, you'll get it.
Increase the manufacturing sector.
It increases the manufacturing sector. It's a stimulus for the manufacturing, local manufacturing. So it can be either import substitution or exports. The government is not distinguishing between that. पहले क्या होता था? Export subsidy होता था. That is not allowed under WTO.
Thank you.
I think impact on the Indian economy, this is the growing inflation in the Western countries. Would it impact our economy?
Yes, because the whole world is linked, right? We do export goods and services to the rest of the world. So negative is that can slow down. And IT has been growing so fast in the last 3-4 years that if that slow down, that impacts India. There can be positives also, like oil prices can come down. And our largest import commodity is oil. So if oil comes down, then our inflation and our deficit, our trade deficit actually goes down. So there are kind of pros and cons, I would say. But the pros are mostly on the oil side. But I would say the cons outweigh the pros. So we would want the global economy to grow rather than slow down.
Investments, I like global investors investing in the Indian economy. If the inflations are high, would they feel that debt would be more attractive than
that's what we say. And second is 2 years ago, the 10-year US bond was giving you 1%. Now the 10-year US bond is giving you 5%. So if you're a pension fund manager, you had put money into other markets because there was no returns in the US. If you're a pension fund, endowment, global portfolio manager. But now when the US 10 risk-free rate has become 5%, then you will not probably allocate that much to other markets because your domestic bonds are giving you better returns. So that can impact fund flows to the global markets like India.
Also, this one last infrastructure side, I think the government is doing a lot of things on the infra side. A lot of money in the infra side comes from the sovereign fund and the pension fund. So
no, that is when they privatize it or sell it out. NHI.
Yeah. So on this
No, this is direct government spending. Does not include the other things.
Your comments on
current account deficit? That is more to kind of give a signal to the market, frankly, rather than obviously. But otherwise, interest rates in India, I don't think that much of an issue yet. Because as I said, now Indian 10-year bond yield was 7% 10 years ago also. So हमको इतना फर्क नहीं पड़ा. We are used to 5% inflation. The West is not used to 5% inflation.
You said the manufacturing sector is around 15-16% of the GDP right now, and it's going to be around 20-21% in by 2030. So, according to what's the government policy with your experience, what are the sectors in the manufacturing which will take us from 16% to 20-21% in 5-6 years?
I think all sectors. It will be all sectors. automobiles, capital goods, you can say chemicals, everything across the board. Because the PLI schemes are there in most sectors. कई तो नए sectors से जो भी आए नहीं है.
Okay.
And plus also don't forget the energy part, new energy. That also requires so much investment. उसके लिए भी equipment, construction वगैरह चाहिएगा.
Within all these.
And semiconductors, which is not yet there.
Within these manufacturing sectors, going to be in all the manufacturing, which are the basically each segment, we will be catering to all these manufacturing, maybe fastener, something like that. Some which could be the basic which all these manufacturing industries or factories.
कोई भी, I mean, that. So either you buy the, either you dig for gold, or you buy the, or you invest in the person who is going to supply the shovels and trucks. Right. So when you are setting up manufacturing, you need to set up the building, you need to buy the plant and machinery, right? So that's why the capital goods guys are doing well. तो पहले तो प्लांट बनाना पड़ेगा, बिल्डिंग बनानी पड़ेगी, इलेक्ट्रिकल ट्रांसफॉर्मर सबस्टेशन आएगा, पावर केबल्स लगेंगे, सब. That's why all these segments are kind of, doing well.
This JP Morgan is including our Indian government securities
in the global bond index. Yes.
make any difference to our
Inflation में फर्क नहीं पड़ेगा, but flows improve हो जाए. At least one more option. Money, it's a one more option for global funds to put money in Indian debt.
So that will have an impact on the dollar rate, something like maybe.
I don't think it's going to be $100 billion of money coming in, frankly. Yeah. So थोड़ा फर्क पड़ेगा, but not really worth quantifying.
इंडिया का मैक्सिमम पॉपुलेशन रूरल एरिया में है और उनका मेन एक्टिविटी एग्रीकल्चर.
Yes.
वो बहुत अनऑर्गेनाइज्ड है आज के डेट में.
Yes.
इसमें कब रिवॉल्यूशनरी चेंज आएंगे?
रिवॉल्यूशनरी चेंज आ रहे हैं.
तो that result will be wonderful.
मैं तो गुजरात में देखता हूँ. I mean, I think there is some person in Kutch who's, I think, planning to export tulips. हाँ, नहीं चीकू चिप्स तो चलो ठीक है. Tulips from Kutch, because सारे सौराष्ट्र, नॉर्थ गुजरात, कच्छ में धीरे धीरे करके नर्मदा का पानी आ रहा है. So land which was earlier not being that used, they are using technology from Israel, drip irrigation to minimize water. Land is there, land का कमी कहाँ है? पानी नहीं था. So I think lot of value-added exports in food are already happening from India. In fact, our largest growth rate in agri commodities was actually meat in the last 10 years.
Our farm size is a big problem. We are all small.
हाँ, but people are getting smart. Indian, but then they are using these efficient techniques, na, to enhance. See, the same farm can produce 3 to 4 times the amount of produce if you do it the right way. And now Indian farmers, he may be poor, but he's not stupid. So they are very smart. Yeah, absolutely, they're very smart. Yeah. Absolutely. Yeah. So उनको एक बार सिखा दो तो कर लेते हैं.
Sir, no paper outgoing versus small server funds income. What will grow?
Sorry, come again.
FII का जो पैसा जा रहा है बाहर, इंडिया के बाहर, और जो स्मॉल सेविंग्स का पैसा आ रहा है मार्केट में, कौन सा जीतेगा?
अब तक तो लोकल जीत रहे हैं. बट FII का पैसा लॉन्ग टर्म में तो आता ही है. वो अभी चलो ठीक है, because interest rates out there are going up and they have liquidity, they are not buying or selling whatever. And also China has become so cheap that in spite of all the skepticism about China, they probably maybe putting some money into China also, because इतना underperform किया है China ने, तो थोड़ा सस्ता देख के थोड़ा लेने का मन हो जाता है ना सबको.
तो इन्वेस्ट तो कह रहा है कि higher rate of interest will continue for longer period of time.
Yes, that's what it looks like.
So India has to go like what you see as a rate cycle, maybe another 25.
I probably one more, but I doubt it because I think RBI and government are more focused on growth before the election.
So I'll be asking a few difficult questions, but before that, I thank Maheshji for bringing another gem in front of us to enlighten us. Sir. So thank you, Maheshji and JP Nagar Study Circle.
Thank you.
So your presentation has been very positive, covering very positive sides. Now
Negative भी है, मैंने बोला महंगा है.
you are only getting 20 years of SMEs and mid caps. I believe in last 20 years there has been no crash in SMEs and mid caps as it has been no large corrections. In terms of
नहीं अभी तो हुआ था 2018 में.
that was
आधा हो गया था, आधा SME index sorry small cap index आधा हो गया था 2018 में.
very big correction, sir, in my understanding.
It was a 50% correction in 2018. Yeah.
More points I'm adding.
कितना चाहिए और?
Dots can be connected, and I'll like to enlighten us on those points. So first of all, maybe on deglobalization is said. So when the deglobalization was happening post pandemic.
अभी तो चालू है. अभी तो शुरू हुआ है.
Maybe 27 large corporates moved out of China, none came to India. Even today in USA, it's shifting towards Mexico. From China, it's shifting towards Taiwan and Indonesia. In Europe, if you see, possibly Germany is in doldrums. UK Brexit issue is there, so you don't expect growth over there. Deglobalization coming to India. In India,
no. No. We can't pick and choose, no. Just because somebody moved out of China doesn't mean they have to come to India. That's one thing. Second is, it also depends on how fast they want to do it. So if they want to do it really fast, they probably go to Vietnam because Vietnam is nothing but an extension of China only. Vietnam is owned by China. So खाली label change हो जाता है. Okay, so that's one thing. Second is, why do you forget the fact that Samsung and Apple and all the big guys have expanded their capacities by 3 to 5 times in the last 2 years in India. Apple iPhone manufacturing for the first time is happening in India, right? So,
that's a very small percentage.
जब रातों थोड़ी होता है.
Second thing, we are welcoming outsiders, but maybe that acquisition, etc. for Indian businessmen is not a problem, except for Gujarat, maybe for whatever reason, state and center are on the same page. That is labor reform, land reform.
I don't think land is a problem. नोएडा में कोई प्रॉब्लम नहीं है, गुड़गांव में कोई प्रॉब्लम नहीं है, चेन्नई में कोई प्रॉब्लम नहीं है, बैंगलोर में कोई प्रॉब्लम नहीं है. No, industrial. There is no problem with land. Yeah.
I'll give practical cases.
No. See, I'm not saying corruption is not there, but I'm saying अगर किसी को बड़ा इन्वेस्टमेंट करना है इंडिया में, तो I think the environment is much more conducive than before.
Okay, that I agree. So another thing is, maybe the population of India at the time of independence was roughly around 27 crores. Today it is roughly around 140 crores. 5 times the growth. Do you think the population is going to increase in that way? I don't think so.Maybe another 20-25 crores will be added and then we will be reducing the population like China.
Correct.
So where will the growth in real estate come from?
Growth in? अरे वो तो आप 30 साल के बाद की बात कर रहे हो. वो 30 साल के बाद की बात कर रहे हो. हाँ. ये है. टाइम हो गया? नहीं दिखा ये. India's population will peak in 2045.
Please keep sitting for the next 5 minutes.
2045 में हमारा पीक आएगा. बहुत टाइम है. तब तक अपने पैसे बन जाएंगे.
I request you all to please keep sitting for the next 5 minutes.
Okay, can I?
Yeah.
Okay, thank you.
Thank you, Mihir ji, for the very informative and illustrative session. For the formal vote of thanks, I would like to invite CA N.K. Jain sir, our past convener. After the vote of thanks, we'll have the lucky draw, which is a part of the 25th Silver Jubilee celebration. Then we have a short break of 20 minutes and we assemble back because the second speaker is already here. And after the equity markets, it's time we understand the debt market as well. So request you all to please assemble back soon after the break.
Thank you, Purvi. In our today's first session, Mr. Mihir Vora has given us systematically how to read the capital market, and he has given with full data and charts. I think more than 100 charts were there. And this is the first time I have seen in 1 hour presentation, more than 100 charts are there. And he has really given us the way that we should buy India. And in India, he has also given sectors, which sectors we should invest. He has also given opportunities and threats as well. And he has suggested to invest for a long term with the SIP. The only thing remains unanswered is Sulevanu. That I think we can interact during the break. And with this, I request all of you to join me with a big round of applause. Thank you.